The extra QE in Japan has led to a decline in the yen, arguably a capital flight from Japan into other asset classes. I think the biggest beneficiary has been the US markets. That's partly why the dollar has been going up. Treasury yields are kept low. And the liquidity effect arguably is also positive for Asia ex-Japan markets, as some of that capital goes to Asia ex-Japan. However, the economic effect of a slower economy in Japan is negative, and it has led to weakenings of currencies in Asia, particularly the Korean won. Japan is getting more competitive with a number of manufactured products, and we think that will lead to slower growth rates in particularly Northeast Asia, but other parts of Asia as well, because of this deflationary impact. So the strengthening US dollar is the flip side of other currencies weakening. There is a flight to the US dollar as people see that the economy there is stronger, that other economies around the world have been weakening. Japan, China, Russia, Europe. It does create a bit of a sucking out of liquidity from Asia and emerging markets to the US. And I think for the moment it will probably put a bit of a cap on equity markets in emerging markets and Asia, even though valuations appear to be better or lower than in the US. I've never used hedging, and I'm not planning to. I think once you start getting into hedging, it does take away a bit of your attention. You have to pay fees for it, and you may get it wrong as well as right. So if we have very strong currency views, we'll take them into account when choosing the equities. Either we'll favour some exporters, or we'll have a more defensive portfolio generally. At the moment, we do feel the portfolio is reasonably defensively set up. So if markets fall, whether it's in dollar terms or even in local currency terms, we would expect to outperform. But no, I'm not planning to use any hedging.